All right, let's talk about NIO. This is a name that really gets investors fired up, right? For some, it's the future of electric vehicles. For others, it's just a company that's burning through a ton of cash. So today, we're going to cut through all that noise. We're going to dive deep into the fundamentals, look at the valuation, and figure out what the numbers are actually telling us. At the very heart of the NIO story, there's this real tug-of-war going on. Is this a supercharged growth company that's about to take over the premium EV world? Or is it a classic profit trap, just burning cash with no clear way to actually make money? That is the big question we're going to tackle. And this number right here, $4.93, this is our starting point. This was the stock price as of early 2024. And really, everything we talk about today comes back to this. Based on its performance and its potential, is this price a total bargain, or is it a major red flag? Okay, so first things first. We're going to start with a high-level look at the company's fundamental scorecard. Think of it like a quick health checkup, It gives us an immediate sense of NIO's overall condition before we start getting into all the nitty-gritty details. And here we go. The source gives NIO a fundamental score of 55 out of 100. So it's not a failing grade, but it's definitely not getting straight A's either. It's right in the middle. And that tells you there's a serious battle happening under the hood between the company's strengths and its weaknesses. Let's see what that looks like. So this is where the story really gets interesting, and you can see that whole growth versus profit problem in black and white. Just look at the top line. Revenue growth is almost 17%. That's pretty strong, right? It shows people want their cars, they're expanding. But then you look at the bottom line, a negative 14.8% operating margin. This is the big one. It means that for every $100 of cars they sell, they're actually losing almost $15 just on the operations to build and sell them. That's the cash burn that makes investors so nervous. And it is, without a doubt, the single biggest problem NIO has to solve. Okay, so with that pretty stark contrast in mind, let's look at the good stuff first. The case for optimism. What's actually powering that nearly 17% revenue growth? This is the bull case for NIO. First off, you've got to understand their game plan. NIO is not trying to be just another car company. No way. They're positioning themselves as a premium, high-tech lifestyle brand, kind of like the Apple of the EV space. They've got a strong base in China, and now they're making a real push into the super competitive European market. This whole premium global strategy is the key to their entire investment case. And this is basically their roadmap for how they plan to get there. It boils down to 4 key things. 1, keep launching new models to keep things fresh and attract different buyers. 2, keep expanding into new countries to grow that customer base. 3, this is a big one, scale. The idea is the more cars they build, the cheaper each car becomes to make, and eventually those losses turn into profits. And 4, a really crucial piece of the puzzle, is their battery swapping technology. It's something that really makes them stand out from the crowd. But that growth story is not a sure thing, not by a long shot. For every potential positive, there's a pretty big risk. So now let's flip the coin and look at the hurdles that could seriously trip NIO up. And the absolute biggest hurdle is the competition. I mean, this isn't some empty playground, it's an all-out war. NIO is going toe-to-toe with absolute giants. You've got Tesla, the king of the hill. You've got BYD, another Chinese monster that's growing like crazy. And then you have all the old-school car makers, VW, Mercedes, you name it. And they're all pouring billions and billions into their own EVs. The pressure is just immense. And beyond just the competition, there are other huge risks to think about. First, plain and simple, execution. Can they actually build and deliver enough cars to hit their targets and get to that scale we talked about? It's a massive challenge. Second, they are tied to the Chinese economy. If Chinese consumers start tightening their belts, well, expensive cars like NIO's are one of the first things to get cut from the shopping list. And finally, you've got politics and regulations. Policies in China and Europe can change on a dime and affect everything from subsidies to sales. So, we've got the bull case for massive growth on one side, and the bear case that's all about huge risks and brutal competition on the other. How do you possibly weigh all that? Well, let's see what the final verdict is from our source material. And it all comes back to this one single, all-important question. It's the tightrope that NIO has to walk. Can they pull off all those growth plans we talked about while at the same time fixing that ugly negative operating margin and finally start making money? That's the entire investment thesis, right there in one sentence. And here it is, the conclusion. The signal is a hold. So what does that really mean? It means that at this price, the risks and the potential rewards seem pretty evenly matched. That potential for growth, it's real, it's exciting. But those challenges, they are just as big. So the recommendation is basically to be patient. Take a step back, wait for more proof that the company can actually pull off that incredible balancing act. And we're going to end on this really important piece of advice. What we've done today is fundamental analysis. We've been trying to understand the why behind a company's value. But that should always be paired with technical analysis, which helps you understand the when of it all. It's a great reminder that smart investing means looking at the whole picture. So the real final question is, based on this why, what does your read on the when tell you?